Have you ever wondered how multifamily real estate can offer resilience in an uncertain economic climate? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. In today's volatile markets, traditional portfolio rebalancing strategies are being reevaluated. Multifamily real estate has emerged as a strategic alternative, blending the stability of essential demand with the growth potential of a sector poised for normalization. According to Philip Carter, writing for AMA on August 11, 2025, this asset class offers resilience amid economic uncertainty, with 2025 fundamentals showing stabilized vacancy rates, 1.7% rent growth, and compressed cap rates. This signals cautious investor optimism as new deliveries are outpaced by net absorption for the first time since 2021. The appeal of multifamily real estate lies in its low beta of 0.6 compared to the S&P 500's 1.0, which provides a diversification tool to reduce portfolio risk. Experts recommend allocating 10 to 15% to multifamily real estate, focusing on value-add opportunities in high-demand, low-supply markets. This sector's ability to hedge against inflation and generate tax-efficient cash flow makes it a compelling option for those seeking to diversify their portfolios. The fundamentals of multifamily real estate have shown a turning point, as recent data suggests. While vacancy levels remain above the long-term average, the sector's fundamentals are strengthening. Rent growth, though moderated, is supported by robust demand driven by demographic shifts, urban migration, and the affordability gap between renting and owning. Cap rates for core and value-add multifamily assets have shown slight compression, reflecting cautious optimism among investors. Rebalancing through diversification and risk mitigation is a modern portfolio theory that emphasizes the importance of reducing volatility and aligning with an investor's risk tolerance. Multifamily real estate offers a unique combination of cash flow stability, low correlation to public equities, and inflation hedging potential. From 2000 to 2024, the NCRIF Apartment Index outperformed the S&P 500, delivering 535% total returns compared to the S&P 500's 527%. This historical performance underscores the resilience of multifamily real estate, suggesting it can act as a buffer during market corrections when integrated into a rebalanced portfolio. While multifamily real estate offers compelling returns, its illiquidity requires careful consideration. Unlike publicly traded assets, private real estate investments typically involve longer holding periods and complex exit strategies. However, this illiquidity can be an advantage for disciplined investors, as it discourages short-term overreactions to market fluctuations. The sector's structural advantages, such as the affordability gap and declining new construction, ensure sustained demand, particularly in markets with strong population growth. Compared to traditional rebalancing methods that rely heavily on public equities and bonds, multifamily real estate offers a more stable risk-return profile. Public equities are vulnerable to overvaluation and policy shifts, while bonds face yield volatility and inflation erosion. Multifamily real estate, with its lower volatility and consistent cash flow, provides a counterbalance. The sector's ability to generate tax-efficient income makes it an attractive addition to portfolios seeking to reduce overall risk. As the multifamily market transitions into a more balanced phase by 2026, investors are presented with a strategic inflection point. The sector's improving fundamentals, stabilizing vacancy rates, moderate rent growth, and declining construction activity position it for long-term value appreciation. By integrating multifamily real estate into rebalancing frameworks, investors can diversify away from volatile asset classes, hedge against inflation, and capitalize on the sector's resilience. For those considering this approach, the key lies in aligning investments with regional demand drivers, operational efficiency, and long-term supply dynamics. In conclusion, multifamily real estate offers a path to stability and growth in a world of uncertainty. For investors willing to embrace its strategic potential, the rewards could be substantial. This episode highlights how multifamily real estate can redefine portfolio resilience and become a central component of a diversified investment strategy. Let's talk about the Canada Mortgage and Housing Corporation's Improvement Mortgage Loan Insurance, a significant tool for homebuyers and those building new homes. This initiative provides greater financing choices for home improvements and new construction, making it easier for Canadians to finance their residential property purchases with lower down payments. CMHCs. Improvement Mortgage Loan Insurance offers insured financing up to 95% of the as-improved value for one or two-unit owner-occupied properties, and up to 90% for three- or four-unit properties. This means that down payments are based on the lower of market value or purchase price, or the cost of construction, which can significantly ease the financial burden on home buyers and builders. For new construction, eligibility requires that the financing is approved by CMHC before construction begins. The lender must have control of the entire building during the construction period, and CMHC insured financing, along with any equity in the land, must be utilized for construction and project completion. Importantly, condominium construction financing and loan advances on vacant land are not permitted under this program. When it comes to flexible advancing options, the CMHC improvement offers both single and progress advances. Single advances are used for improvement costs that are 10% or less of the as-improved value, while progress advances are for costs greater than 10%. These options provide borrowers with the flexibility needed to manage their construction or improvement projects effectively. For those looking to build new homes, a new home warranty is a must. Evidence of enrollment in a recognized new home warranty program is required in all provinces and territories where such programs are available. If not, an occupancy permit or a third-party report confirming compliance with applicable bylaws and regulations will suffice. The CMHC improvement also outlines specific loan-to-value ratios, with up to 95% LTV for 1 to 2 unit owner-occupied properties and up to 90% for 3 to 4 unit properties. For small rental loans, the minimum equity requirement is 20%, with a maximum purchase price or lending value for homeowner loans capped at $1.5 million. It's important to note that traditional down payments can come from sources like savings or the sale of a property, but non-traditional down payments, such as unsecured personal loans, are only available for 1 or 2 unit properties with a loan-to-value ratio of 90.01% to 95% and only for borrowers with a strong credit management history. The CMHC Improvement Mortgage Loan Insurance also sets out clear guidelines around creditworthiness and debt service ratios. At least one borrower must have a minimum credit score of 600, and the gross debt service ratio must not exceed 39%, while the total debt service ratio should not exceed 44%. These measures ensure borrowers are in a strong financial position to manage their loans. Overall, the CMHC Improvement Mortgage Loan Insurance is a robust framework that supports Canadians in their home purchase and improvement endeavors. By offering insured financing options and flexible advancing strategies, it provides a pathway to home ownership and property improvement that is both accessible and manageable. In a significant move within the commercial real estate sector, Colliers International Group Incorporated has announced the rebranding of its investment management division to Harrison Street Asset Management. This comes as part of a strategic effort to harness the expertise of their partners and position Harrison Street as a premier global investment partner. The announcement was made on July 23, 2025 by Colliers, a Toronto-based commercial real estate services firm and asset manager. According to Tyler Choi, writing for Ranks.ca, Christopher Merrill, co-founder and chief executive officer of Harrison Street, will now take on the additional role of Global Chief Executive Officer and become the largest individual shareholder of the newly branded Harrison Street. Colliers' co-chief investment officer, Zachary Michaud, is set to join Harrison Street as managing partner and global chief financial officer, while Harrison Street's chief financial officer, Stephen Gordon, will assume the additional roles of managing partner and global chief operating officer. Other leadership roles across Harrison Street's specialized operating platforms will remain unchanged. Merrill expressed optimism about the rebranding, stating, "By harnessing the expertise of our partners and teams across the platform, we aim to scale our capabilities and position Harrison Street as a premier global investment partner." With over 2 decades of leadership in alternative investment management across infrastructure, real estate, and credit, Harrison Street is poised to deliver innovative investment and capital solutions for its clients. Colliers initially acquired a 75% ownership interest in Chicago-based Harrison Street in 2018, investing up to $550 million United States dollars for the stake. The two companies now manage approximately $100 billion in assets and operate globally. Known for its real estate services and industry research, Colliers has been actively expanding its reach, acquiring several companies, including Triovest's Canadian commercial real estate services platform earlier this year. Harrison Street focuses on alternative real estate, including student housing, seniors living, medical offices, life sciences, storage, and digital assets. In Canada, the company has made several acquisitions, including Le Mille Doré, a 279-bed project in downtown Montreal, and a partnership with Greycorp Properties to develop a 645-unit student and working professional housing project in Calgary's University District. Additionally, their acquisition of the Evolution Block in Vancouver marked their first Canadian life sciences asset. Harrison Street plans to continue utilizing the expertise of investment professionals from Basalt Infrastructure Partners, Versus Capital, Rockwood Capital, and Colliers Global Investors after the rebranding. The company also aims to expand its global distribution capabilities and pursue new strategies, asset classes, and verticals, further solidifying its position in the global market. This rebranding signifies not just a change in name, but a strategic evolution in the way Colliers and Harrison Street approach investment management. With the combined expertise and resources, they are well positioned to navigate the complexities of the global market, offering innovative solutions to investors worldwide. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.